2022 off to one of its worst starts in history. Equities down, bonds down, gold. I could go on. Pretty much all asset classes are down year to date. Pretty bad so far. What do we see going forward? We're going to talk about that and a lot more. Sit back, let's go. Hello and welcome to Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, we are a registered investment advisory firm, which means we work with individual clients. So what you see here, we do apply to our models, portfolios, etc. So if you like what you hear, please do consider subscribing. So in the intro, yes, 2022, real difficult. What do you got to do? Number one, stop listening to those talking heads on TV. Buy. They have an agenda, right? My job is to manage risk and work with clients. So today, we're going to talk about where we've been, what we see coming from a macro and a technical standpoint. Get you ready as we go forward. So first up, we're going to talk about our market cycles. We're going to get into those charts, all right, and then we're going to have a game plan. So let's go to the big board. All right, first up, let's follow up on that comment about those talking heads. Have a couple clips here, some lowlights, and what I'm talking about, right? Rest in peace, the bear market. That's when we had that surge in August, all right? Josh Brown, a little over a week ago, said we're ready for a rip-roaring rally, okay? Keep in mind, their job is to entertain and sell advertising. Of course, Mr. Kramer's made all kinds of calls, right? Time to get in there and start buying. He has called more bottoms than you can imagine. And Friday, Tom Lee, which is just amazing to me, reiterated his 5,100 call. We'll see. I don't believe that's the case, okay? Next up, let's talk about how we manage risk and what our objective is, all right? You've got the bottom. We're not there yet, we believe. You've got the top, which is around November, okay? That first 10% move is always the toughest to manage. Don't know what it's going to look like, how fast, the ferocity, et cetera, But the key is when you get here, you got to really manage that risk, mitigate risk, okay? And that's what we try and do with our process. So our process starts with the cycles. This comes from macroeconomic data, okay, is what we focus on. Growth, inflation, and policy, all right? So right now we are in cycle 4. We believe what's a deep cycle 4, okay, with growth slowing. Going to get into that in a second. Inflation decelerates, okay? I know we've talked about this quite a bit in my videos. We are seeing a lot of points, whether it's lumber, oil, etc. I could go on. We are seeing disinflation. Some pockets are keeping it up, but slowly this will move down. And then policy, normally the Fed's dovish, but that's the problem, right? We've got a very hawkish Fed right now. So let's look at some of the data, talk about growth, right? Last week, here's some headlines again. Nike, Micron, Apple, right? All going in and saying sales just aren't what they expected. Everyone was looking at a rosy picture in the beginning of the year. Not our call. They don't do macro data, obviously, okay? And this obviously really affected the market as we go forward. This is one of the things we'll talk about later, but this is what we'll call a profit recession. Not just a recession, but that's what we see coming forward. Take a big look at as we come up on earnings season. And this was just astonishing last week. Janet Yellen, no, she's not the Fed chair. She is the Treasury Secretary, but markets are functioning real well, all right? I don't see any liquidity or deleveraging. Now, let me tell you, okay? Over here is high yield, how they come together. We got high yield spreads going up. Together, we talk about this, the fish biting, okay? That's not a good sign. Liquidity is drying up in this market, which is very common in a volatile market, and we'll talk about that in a second, because the same day that she did that, we had some major issues in the European market. Bank of England warns of material risk to UK financial stability, okay? So basically what happened was pension funds, hedge funds were not leveraged correctly, and they had to step in, okay? Here's some quotes, going to be tough to see, but this is a major issue. Basically what this says here in the quote is very close to a Lehman type moment. We know what happened then. Not saying that's happening, but there are some real funky things going on in this market right now that we have to be really aware of. And when you look at overall, I've got a chart here of two of the major banks, Credit Suisse and Deutsche Bank. Look what's going on there. Not going to get into it. You can look these companies up. A lot of rumors, lots of articles this weekend about these banks, but they are having some major issues which could have an impact, obviously, on the overall global markets. Next up, our Fed, right? We've got 4.72, and that comes out to meaning raises, rate hikes, okay, times 0.25. Okay, that's what we're expecting. As of now, we're looking at 0.75 at our next meeting, which seems pretty aggressive. A lot of people are saying it's time to slow down because we're starting to see the markets really break. So we know about this, have spoken about this, right? This is the fastest rate hike in history. That's the problem. It is coming fast and furious. The markets are really struggling with this. And overall, it has been orderly because the other piece of it, quantitative tightening, okay, you have easing when they're flooding the market with liquidity, tightening, taking money out, okay, and that's what you see right here. This is the long-term view. Well, finally, and I mean finally, I talked about this in my last video, they're starting to pull money out. You can see it go down, and they're looking at 85 to 95 billion a month of burning off on the balance sheet. So that's why we believe a lot of volatility here in the last couple of weeks, okay? So next up, let's go to the big charts. All right, so here's where we're going to start to kind of give you a broad picture of how deep and wide this is, okay? These are various ETFs, what I call core ETFs. You've got the SPY, S&P, the Qs, NASDAQ 100, small cap, mid cap, international, emerging markets, right? And we're looking at 23, 32, 27, right? Big numbers here. But here's the other problem, right? On the right-hand side here are bonds. Bond ETFs, the most utilized. You've got the 7 to 10-year IEF down 15%. TLT, okay, which is a 20-year highly utilized ETF down 29%. And how about long duration at 37%? So this is the issue we've had. There's not a lot of places to go. You're a 60-40 investor. You are really getting affected on both sides. Through Friday, some of my numbers, we're looking at a 60-40 portfolio being down 22+%, which of course is a big issue. So let's take a look at our signals. Obviously, you can figure this out pretty quickly. Monthly, we are in a big time downtrend. We've got a negative crossover down here. So the long-term signal is negative, okay? On the midterm, on the weekly chart, we had a major breakthrough, okay? When you look at this over here, right, this is a trend line going back to 2009, and we broke that trend line. That's an issue, right? Let's see what happens here as we go forward, but obviously we're going to be watching that one real closely. So here's our daily chart. Obviously, again, not good looking at all. Okay, our most recent downturn, we topped out on August the 15th, hit that 200-day and rolled over. We're down 17.19% from that, okay? We are definitively in a downtrend. Once again, as I said last time, is there anything here that stands out? One, companies above 500-day moving average, 16. Was 3 about a few days ago. 16 companies above their 50-day moving average. But still, volatility is something that has been somewhat anemic, okay? We are above 30. We've closed above 30 in what we'll call that uninvestable bucket, but we haven't had that surge like we've had in other markets, and I think a lot of people, myself included, right? We're looking at, are we going to go? If you go to 2020, the VIX spiked to 85, okay? So overall, the VIX index is kind of hung in there. So that's why we're a little bit, we're seeing what's going on. I do think We are seeing extreme oversold conditions. Might be an opportunity this week to see a little bit of a bounce. We will look into that as we go forward. So next up is the NASDAQ. Here we're really getting hurt, down 35% from the top. I mean, this is really bad, and I think a lot of people, like you saw in Kramer's quote, time to buy. There's a reason they're down, right? They are hurting big time. You probably saw Facebook coming out this week and cutting costs and cutting people for the first time in history. There's a lot going on. Apple changing projections on the new iPhone. People aren't buying them. Who's got the money, right? And this is exactly what's going on right now, which really has us concerned. So let's go to Sector Spotlight. Well, Sector Spotlight, not a lot to spotlight on right now because we are in a large position of cash right now, waiting for some opportunities we'll talk about in a second. So number one position has been the dollar. We trimmed at one point, and then when the pullback, when we saw this pullback over here, we added back to it, and I added again this week on this pullback. So we've got a nice big double-digit position on this. We do feel that that should continue on because of what's happening, right? Especially what's happening in Europe right now with their 10-year, the gilt and their financial issues, okay? So the dollar looks to stay strong. Now, again, I'll go through this, which I call my most important chart of 2022. Bonds have been just a disaster. I showed you that on the performance numbers and where we are year to date, right? You can kind of see my channels here, pretty definitive. All right, we're up there at 3.8. All right, we got close. We hit 4% and bounced off it, okay? And we'll talk about this. I mean, what's happening right now is until the market really breaks, and what I mean by that, yes, the stock market is down. Of course it is. It's painful. But there's still unemployment, some other things that are really holding us up. And as I keep calling this, the pain trade, the flight to quality, just has not happened at this point. And that's my concern, okay? So, which means we're really not in bonds. I think I have 3% right now. I've been as much as 20, down to 3%, and I'm waiting, and really just a huge cash position. And the other one is gold, right? Gold looks pretty much the same. Gold is very correlated with the 10-year, meaning it moves with it, okay? Cut our position. You know, normally in this type of cycle, we'll go as much as 12%. We're at like 1.7 right now. Again, waiting patiently. So let's wrap this up with our game plan as we go forward. All right, so next up, we've got a new chart. This is a quarterly chart showing a trend we have not seen except in 2000 and 2008. We go back to 1993, we see things move up. But what's happened is when we look at a downtrend and we confirm that downtrend, okay, you see 3 quarters in a row. I'll zoom in. You can see it back in 2000. 3 negative quarters. 2008, it continued. And right now, we have just had 3 straight negative quarters. That is an issue, a big issue, clearly confirming this downtrend. Now, what are some of the parts of a downtrend from a technical standpoint? All right, the first one is phase 1 is going to be overpriced stocks, right? This was the everything bubble, right? Everything, stocks, bonds, crypto, right? I could go on and on. Everything was overpriced. We're seeing that overpriced right now. Phase 2, which I believe we're about to start, is economic ills. That's the profit recession I spoke about, okay? And the last piece is despair. Obviously, we're not there yet. That's when everyone's selling out and when you have that capitulation and you see exhaustion of selling, okay? Again, phase 1, we've already completed. I believe we're going into phase 2 here shortly as we enter this next quarter, and then despair. So from there, you can kind of look at it from some other ideas here. Once we get there, you have that first move. It shows you what happens next, right? After you're down 20%, again, going to 2000, 2008. Then you had your next move, 35, 45, and right now, again, we are down 23% caught in the S&P. Gives you an idea of our next move. Okay, everyone wants to know how long these are. You can read this chart, you can pause it, but basically, average peak to trough when the Fed is done raising rates is 21 months. Okay, so we've got some time here. This is definitely the beginning of a long-term trend. One more slide to show the phases here. Okay, we've got housing. I think everyone's aware. Waiting for that. Inventory is still tight. You've got institutional buyers, individual buyers who own multiple homes. When that starts happening, we'll see it. I'm seeing here locally, we've got a big development, a big money development. My wife does staging. All of a sudden, she's getting a lot of staging deals. And there's a neighborhood here that's got 6 homes for sale on just one street. So we know that that's already happened. The next two we talked about, which are orders and profits. That's the phase we're seeing right now, profit recession as we go forward. The last one is employment, always the biggest laggard, okay? And when you look at that, here's a chart. You can see it going down, which has surprised a lot of people, myself included. Now, summer's generally strong, okay? But there are some factors, right? One, because of the medical issue, we had a lot of 200,000 in deaths, okay? 2 million reportedly fell out of the labor force. And overall, we've got over 8 million workers gone over the last few years. So that's why it's such a tight labor market. We'll continue to look at that as we go forward. So game plan, cash is king right now. Doesn't feel good, but it's a hedge, right? It doesn't go up or down, all right? Cash is definitely king. We have a large position of cash, okay? Bonds, gold, and hedges, we talked about that as far as what's coming on that idea, the hedges, okay? So if we do, I'll talk about the hedges in a second. If we do get this upswing, sell on those bounces, take advantage of it, raise some cash until we see those opportunities. Maybe we'll see how things go this week. If we see a short-term bounce, we might participate a little bit in that with some definite stop losses to get ourselves maybe positioned better. But once we feel we're at the top, we're going to look at adding some more hedges as we go forward. I've done a video on that. So thanks for watching. Michael Loftus, Wealth and Wisdom TV.